Bonds. Once a friend of the average investor, always earning a place in a portfolio. But now, they're just that weirdo at the party, and most people wouldn't touch them with a 10-foot barge pole. So, with bond returns nearing all-time lows and future prospects looking bleak, it poses a question: should we hold bonds? I just need to quickly remind you that I am not a financial advisor. So, before you take any of the information in this video as financial advice, just remember that I'm a random guy. If you want independent advice tailored to your own circumstances, then seek that from a professional. Before we look into why we might not be able to trust fixed income anymore, and before we explore our alternative options, let's first take a look at the problem. In a classic investment portfolio, there are normally two options: equities and bonds. Equities, or stocks, are the brawn of the portfolio. That's what's going to do all of the lifting and earn you the returns that you really want. In investing, there is generally a relationship between risk and reward. If you want higher returns, then you're going to have to take on more risk. Young investors typically only invest in equities and completely ignore bonds because equities are more risky, and so they want to take on the maximum risk to get the maximum reward. Bonds, on the other hand, typically carry less risk than equities, so they have lower expected returns. However, investors who are approaching retirement typically add bonds to their portfolio to reduce the overall risk of a portfolio and to preserve their wealth. Bonds also play a key part in diversification. If you invest in a portfolio that has both bonds and equities, then you're diversified across different asset classes. An example of this being useful would be when stocks or equities inevitably crash, which they always do. The bonds in your portfolio may not necessarily crash, which means that your fall is going to be a lot less harsh. It'll be cushioned, if you will. This gave rise to a classic: the 60-40 portfolio, which is one of the most popular portfolios in the world. It contains 60% equities and 40% bonds, which, for many people, is the perfect balance between risk and reward. The 60% equities drive the returns of a portfolio, whilst the 40% bonds smooth out the returns and cushion any falls. Another benefit of this portfolio is that bonds provide fixed income. They typically have a set yield, which means that you're going to get periodic interest payments just for holding the bond. Back in the day, this was ideal for retirees. Not only are you taking on less risk by investing in bonds, but then you're also getting provided with a steady income, which you can live off during your retirement. However, the problem is that nowadays, the yield of a bond barely exceeds inflation. So, is it still a good idea to hold them? Before we look at that, let's first take a look at how bonds work, and how on earth we got into this mess in the first place. When you buy a bond, you are essentially loaning a corporation or a government some money. Because you're providing them with a loan, you get paid interest for your kind gesture. This is the bond yield that we talked about earlier. So, when you invest in a bond, there are two aspects which define how much money you're going to make. There is the change in the price of the bond that you bought, and then there is also the yield, the regular payments that you're going to receive. The confusing part is that these two things work in the opposite direction. When the bond yield rises, the price of the bond falls. And when the bond yield decreases, the price of the bond goes up. So, as investors, whilst having a nice high yield on a bond is nice, we typically want bond yields to fall, so that the price of the bonds that we've invested in go up, so that we can make a profit. This graph shows the yield of a 10-year US Treasury bill, the most liquid and widely traded bond in the world. We have data from 1962. You can see that the yield varies a lot, reaching a peak of almost 16% in 1981. However, since that peak, there has been a steady fall in interest rates, all the way to today, where it is currently around 1.7%. This means that bonds have actually been a great investment over this time period, as the prices of bonds have been steadily rising. There are multiple factors that can affect the yield rates of bonds, but one of the main ones is inflation. Inflation and bond yields typically follow each other. Back in the 80s, inflation was wild, which is also why bond yields were so high. Since then though, governments have enforced monetary and fiscal policies to control inflation, amongst other things, so now it's fallen to a manageable rate. The US and the UK both set an inflation target of around 2%, but in recent months, inflation has started to creep up. This data from the US Bureau shows the annualized inflation rate for each month, and recent months have steadily been above 5%. This article from the BBC claims that the Bank of England's new chief economist has warned that UK inflation is likely to hit or surpass 5% by early next year. So we're nearing all-time lows for bond yields, and inflation is on the rise, which means that bond yields are probably going to rise. So the future expected returns for bonds are looking pretty bleak. This data shows the market yield, or total earned on investment, for the 10-year Treasury bill, when adjusted for inflation. We can see that since early 2020, the returns have actually been negative. With inflation on the rise, this is expected to get worse. Alright, I'm now going to put some happy music on in the background and cheer up the tone of this episode, because I don't know about you, but I've found it pretty depressing so far. Bond returns are looking like they're going to be poor in the future. It's not guaranteed, but it's looking pretty likely. So, what other alternative options do we have? Well, if we end up avoiding bonds altogether, we're not going to have any form of fixed income to live off. Many investors rely on this during retirement, so what can we do instead? Well, of course, we still have dividends. During retirement, we could tilt towards dividend-paying stocks and live off of the income that they provide. This type of investing can be classed as income investing, where you live off of the income, or the yield of your investments. Retirees love this, a steady income to live off of, so that you can do nothing and your investments are going to pay you money whilst you chill out. But what if dividend payments aren't as steady as what they're promised to be? Oh god, back to the doom and gloom. This graph shows the dividend yield of the S&P 500 from when records began. You can see that the current dividend yield over the past 20 years or so has been far below the all-time average. To make it worse, dividend payments in the UK were cut by around 44% when the COVID pandemic first hit us last year. If you were to take a 44% cut to your income, then you'd have to seriously cut back on your spending to even survive. Now, who wants to do that during retirement? This graph from a Vanguard article shows the yield of global bonds in turquoise and then the yield of a 60-40 portfolio, including dividends, in red. You can see that the yield of a 60-40 portfolio has fallen below 2%, despite most people expecting to live off of 4% of their portfolios per year during retirement. So, without any action, retirees could easily burn through their investing pots and run out of money. So, what can we do about it? Well, we could cut our spending down to 2%, but come on. We're retiring, we're chilling, we want to live our life. That's not going to happen. The next option would be to find some other assets that have higher yields. So let's look into that. If we go back to fixed income, then there are actually bonds that offer higher yields, but they also carry more risk. Higher yielding bonds are typically offered by corporations or governments that have a lower credit rating. This means that they could have a higher chance of defaulting on the payments, and you lose out on your money when you're investing. Also, by just focusing on low credit rated bonds, you're reducing the amount of diversification that you can get. Besides, we want the bonds to provide income, which we're normally going to use during retirement. We don't want to worry about payments defaulting. So what else can we do? Another option would be to go all out on dividend paying stocks to try and maximize your yield. However, again, you are massively reducing your diversification by essentially ignoring half of the stock market. These concentrated portfolios will typically carry more risk because the risk is not being spread out as much. This graph shows a breakdown of two indices, the MSCI UK High Dividend Yield Index and the standard MSCI UK Index. The High Dividend Yield Index is much more concentrated in mid-cap value stocks when compared to the standard index. Vanguard used their capital markets model to forecast the returns for the two options. The High Dividend Yield Index actually performed better in high return environments, but at the same time, in a low return environment, it offered much less downside protection than the standard UK index. This was down to reduced diversification. But again, do you want to deal with this during retirement? Significant periods of low returns could be stressful to deal with. To counter this, Vanguard suggests using a total returns investing approach. This is the idea that we don't rely on fixed income or dividend payouts to determine how much we're going to live off of. They argue that this approach gives you much more control. You're in control of how much money you make, not whatever the dividend yield or fixed income yield is at that time. You can combine this with a dynamic spending approach, where you can spend a little more when the markets are doing well, but just cut back just a little bit when the markets aren't doing so well, to increase the longevity of your portfolio. For UK investors, this approach could also be more tax efficient, especially if you're a higher rate taxpayer. For higher rate taxpayers, income is taxed at 40%, whilst dividend payouts are taxed at 32.5%, after their respective tax-free allowances. However, capital gains are taxed at just 20%, which means that you get to keep a lot more of your investments when using the total returns investing approach. When you retire, and especially if you have a large pot of money, the difference between paying 20% tax and an average of around 35% tax is going to be huge, because it's going to be on your entire life savings. So, total return investing would give you more control in what you invest in, you get increased diversification benefits, and you'd even pay less taxes. So, a 100% equity portfolio could be the answer. Are the days of investing in bonds dead? No. Now, if you're confused, then I get it. I've just spoke to you for around 10 minutes, giving you 101 reasons not to invest in bonds. But if you were paying attention at the beginning of the video, I said that bonds are in a portfolio to reduce the risk that you're taking on and to preserve wealth. I've gone down the rabbit hole of investment returns, blah blah blah, because that's what everybody always does. But bonds are not in a portfolio to earn your returns. They're in a portfolio to manage risk. Investing in a 100% equity portfolio is not for everybody. So, if you don't feel comfortable investing in 100% equities, don't do it. Modern investors definitely have a false sense of comfort. We've essentially been in a bull market for around 12 years, minus a little 6-month blip last year. We've had it good. Almost too good. And whilst I'm no financial advisor, I can confidently tell you that it's not going to be this way forever. The last thing that you want to do as an investor is panic during a market crash and sell your investments, locking in a loss of 30, 40, 50% or more. By holding bonds in a portfolio, you would be less likely to panic because the fall would be cushioned and the risk would have been managed. If you get less returns than you would by investing in a 100% equity portfolio, that's fine. That's the point. Less risk equals less reward. Depending on your individual circumstances or investing needs, then bonds may be right for you. And don't let anybody else tell you otherwise. It is so frustrating when I see people in the comment section or random people on Facebook saying that bonds are a terrible investment and that you shouldn't touch them anymore. Yeah, bonds may be dead for you, and that's fine. But they might not be dead for Pauline, who's retiring next year and feels more comfortable holding 40% bonds. Maybe she has a portfolio that she wants to protect, and she wants to make sure that she's protected when the next bear market comes. The more stable Pauline's portfolio is, the less she has to worry about variable spending patterns and spending less when it's a low return environment. I've said it time and time again, and I'm going to keep on saying it. It is much more important for you to invest in a portfolio that you feel comfortable with than to invest in the portfolio that's going to get the maximum returns. And I hate to be a doomsayer, but heed my warning. Bear markets are real. I don't know when they will come, but I know that they will. Some people will be prepared, but many are naive. They don't know what's coming. When the dark times do arrive, those who aren't prepared will pay the consequences. But those who are, will be chilling. So don't listen to what people say you should or shouldn't invest in. Do your own research or talk to an advisor. And if you think that you should hold bonds, then invest in bonds. Risk management is one of the most overlooked aspects of investing, despite it being one of the most important. Poor returns or not, bonds provide stability. And that's exactly what some people need. If you don't think you need it, then make sure that you're ready. And with that, I'll see you next time, guys. Thanks for watching, and happy Halloween.